Orientation. This is a story about Danske Bank, a major Danish financial institution headquartered in Copenhagen, and one small branch it owned in Estonia, a Baltic country between Latvia and Russia. A bank branch is supposed to take deposits, make payments, and check who its customers really are. This branch did something far more dangerous. Between 2007 and 2015, about 200 billion euros in suspicious transactions moved through Danske Bank's Estonian operation. Suspicious does not mean every euro was proven criminal, but it means the flows had warning signs banks are legally required to examine. The issue mattered because modern money moves through trusted banks. If one bank lets hidden owners and shell companies move cash unchecked, that money can enter the European and US financial systems looking clean. So the question is not only how the money moved, the question is how so many warnings were visible, and still the machine kept running. The rise. To understand why the Estonian branch became so important, start in 2007, when Danske Bank acquired Sampo Bank, a Finnish bank that included operations in Estonia. On paper, this was expansion. Danske gained a foothold in a fast-growing region, and the Estonian branch already had a business serving non-resident customers, meaning people and companies based outside Estonia. Many of those customers came from Russia and other former Soviet states, including countries such as Azerbaijan and Ukraine. That kind of cross-border banking can be legitimate. A company may need to pay suppliers or move money internationally. But it becomes high risk when the bank cannot clearly identify the true owner of the money. That true owner is called the beneficial owner, meaning the real person behind an account or company. Here, control was weak from the beginning. The Estonian branch kept using its own information technology system, separate from Danske's main systems. Many documents were in Estonian or Russian, which made oversight from headquarters in Denmark harder. So while Copenhagen owned the branch, it did not fully see the branch. The business also made money. The non-resident portfolio, the group of foreign customer accounts, generated a majority of Danske Estonia's profits before credit losses in 2008 and again from 2011 through 2014. By 2012, Russian non-resident portfolios made up 35% of the local branch's profits. By the end of 2013, Danske Estonian branch held 44% of all non-resident deposits in Estonian banks. That is the tension at the center of the rise. The branch looked small on a map, but financially it was too profitable to ignore and too poorly connected to control. Transition to warning signs. Once a high-risk business grows inside a weak control system, the next question is simple: who noticed? In this case, the answer was almost everyone a bank should listen to. Warning signs. The warning signs were not subtle. Many customers used offshore limited liability partnerships, or LLPs, which can be used for legitimate business, but may also be used to hide ownership. Some accounts relied on nominee directors, people listed as company directors, even though someone else may actually control the business. These structures are classic money laundering red flags because they can make dirty money look like ordinary corporate payments. Money laundering means disguising the source of funds so money from crime appears legal. Inside the Estonian branch, these red flags appeared around large payment flows from non-resident clients. The outside world noticed too. In 2013, JPMorgan Chase, a large U.S. bank that provided access to dollar payments, halted services to the Estonian branch because it suspected the branch was laundering large amounts of Russian money. That decision mattered because international banks depend on correspondent banking, where one bank uses another bank to process payments in a foreign currency or country. When JPMorgan walked away, it was a serious signal. A major partner decided the risk was not worth the business. Then came Howard Wilkinson, the former head of trading for Danske Bank in Estonia, Latvia, and Lithuania. In 2013, Wilkinson confidentially raised concerns with senior management in Estonia and Copenhagen. In January 2014, he made the first of 4 complaints about suspicious account activity. By April 2014, he believed the bank did not intend to act properly, and he told superiors he would report to police if they did not conduct a real investigation. The response he received made the story darker. Danske presented him with a highly restrictive non-disclosure agreement, a legal contract meant to limit what someone can say. Wilkinson resigned in April 2014 for ethical reasons. Around the same period, internal auditors reportedly validated his concerns, and the Estonian Financial Supervision Authority, Estonia's financial regulator, found large-scale, long-lasting, systemic violations of anti-money laundering rules at the branch. Anti-money laundering rules are the checks banks must use to prevent criminals from moving money. Estonian regulators notified Danish authorities in 2014. By then, the warning chain was clear. A U.S. bank had cut ties, a whistleblower had escalated, internal reviewers had seen problems, and a regulator had documented violations. Yet the non-resident portfolio continued operating until 2015. Transition to the collapse. The collapse did not begin with a single raid or one dramatic confession. It began when the old explanation that this was just a distant branch problem became impossible to defend. The collapse. In 2015, Danske Bank terminated the non-resident portfolio, and the last accounts were closed in early 2016. Closing the accounts stopped the flow, but it did not answer the larger question of responsibility. For years, money had moved through a branch with separate systems, foreign language documents, and customers whose ownership could be obscured behind shell companies. A shell company is a company with little or no real business activity, often used to hold or move money. The public reckoning arrived in September 2018, when Danske Bank published an internal investigation. The report acknowledged major deficiencies in controls and governance and said its anti-money laundering procedures had been manifestly insufficient. That phrase mattered because it was not a small technical error. It was the bank admitting that its defenses against financial crime had failed at the center of one of Europe's largest banks. The same day, September 19, 2018, Thomas Borgen, Danske Bank's chief executive officer, resigned. A chief executive officer is the top manager responsible for leading a company. Borgen had overseen Danske's international operations, including Estonia, from 2009 to 2012 before becoming CEO in 2013. He said he held ultimate responsibility, even though the internal investigation did not find he had violated legal obligations. Investors reacted brutally. Danske Bank's shares were halved in value in 2018. The human fallout kept widening. In December 2018, Estonian authorities arrested 10 former employees from the Estonian branch. In February 2019, the Estonian Financial Supervision Authority ordered Danske Bank to cease its activities in Estonia. In September 2019, Ivar Ray, who had headed the Estonian branch from 2007 until 2015, was found dead, with his death reported as suicide. Legal consequences moved slowly. Danish prosecutors charged Borgen in May 2019 with neglecting his responsibilities, then dropped charges against him and 2 other former senior executives in April 2021. Borgen was later acquitted in a civil lawsuit in November 2022. The largest financial penalty came in December 2022. Danske Bank pleaded guilty to conspiracy to commit bank fraud and agreed to pay more than $2 billion to U.S. and Danish authorities. The settlement included the U.S. Department of Justice, which prosecutes federal crimes, the Securities and Exchange Commission, which oversees U.S. securities markets, and Denmark's Special Crime Unit. U.S. authorities said Danske had deceived U.S. banks to keep access to the U.S. financial system and had misled investors about its compliance. A Danish court also ordered about $500 million in penalties and $171 million in forfeiture for violations of Danish financial laws, the largest Danish penalty of its kind. Transition to lessons. The money had stopped moving years earlier, but the lesson only became clear after the fines, resignations, arrests, and investigations exposed the same pattern from different angles. Lessons. The first lesson is that a small branch can create giant risk when headquarters cannot see it clearly. Danske owned the Estonian branch, but separate technology systems and foreign language files made control weaker exactly where the risk was highest. The second lesson is that profits can silence skepticism. The non-resident business produced a large share of local profits, and that made the branch valuable at the same time it was dangerous. The third lesson is that warnings only matter if someone is forced to act on them. JPMorgan cut off services in 2013. Howard Wilkinson escalated concerns in 2013 and 2014. Estonian regulators found systemic violations in 2014. The portfolio still remained open until 2015. Finally, this scandal showed that money laundering is not a back-office issue. It affects investors who rely on truthful disclosures, banks that unknowingly process dirty funds, regulators who must protect public trust, and ordinary people who expect the financial system not to serve hidden criminals. After the scandal, Denmark's parliament increased money laundering penalties eightfold, making them among the toughest in Europe. That reform came after the damage. Danske Bank's Estonian branch became a warning to every global bank. If a profitable blind spot is allowed to grow, it can become larger than the institution's reputation, larger than its defenses, and large enough that the world can no longer ignore it.